And when you look at it, even at a 4% return, if the client's in the 35% bracket, that's really the equivalent of 6.15 taxable, or at a 39.6, that's a 6.62% taxable investment. And so if you're looking at a whole life policy and it's generating a return of in something in the 4% range, on a tax deferred basis and the ability to get tax-free income for a high income taxpayer, that's really a 6% taxable investment. And for something that's conservative, like a whole life contract, that's a pretty attractive yield on that investment. A lot of the clients, a lot of our best clients are business owners. Their businesses have been successful, so they're now very often pretty wealthy, maybe high net worth. They're concerned about if their business is going to continue when they die, how is it going to continue? They're certainly concerned about, am I going to have enough money to retire on and enjoy the retirement that I want? And when with all the conversation about the deficit, I think most of us are figuring at some point taxes are going to go up, and they might be interested in some income tax deductions. One of the things that you'll notice about a lot of your business clients, and you can kind of go through a mental checklist of all of your business clients, but a lot of them have the majority of their net worth tied up in their business. Very often they'll have 70 or 80%, sometimes even more, of their total net worth tied up in their business. And while the business has been very good to them and helped them become wealthy, there's some negatives to it. One of the things is that all of those assets in the business are subject to claims of corporate creditors. So if they get sued, all those assets are at risk. The other thing about the business is most businesses are illiquid, and so we can't convert it to cash quickly or easily. And so if we have to pay an estate tax, for example, business may not be a good source of the money for estate taxes. Depending on how the business is structured, if it's a C corporation, that could be a very high tax environment because there's two layers of tax. You pay tax first at the corporate level, C corporation level, and then we pay tax again when the stockholders receive dividends. So that might be pretty tax inefficient. And the more money that the owner accumulates in his business, the higher the value of the business and the harder it's going to be for the owner to sell. The kind of the habit that the business owner gets into is just accumulating as much money as possible in the business. And usually it's to finance future expansion. A lot of times the business owner in the early years won't have the opportunity to take a lot of income out for themselves. They'll have to pile most of their profit back into the business. And that's true whether it's an S corporation or a C corporation. For the owners of the C corporation, it gets to be a habit, and they just keep plowing money in, and they end up with a whole bunch of money in accumulated earnings. And all that does is make the business harder to sell because it's more valuable, and it ties up a higher percentage of their net worth in their business, which again may not be a good thing. And so one of the conversations that we've been having with business owners over the last 2 years, more or less, has been a discussion about becoming independent of the business. And right now the business is everything. It's your life's work. It's what you do every day. It's the key to most of your net worth. But you're really not independent of the business. And what you've been doing is been stuffing the corporate pocketbook. And what we're going to suggest to our business owner clients is that they can, that they consider stuffing their personal pocketbook for a change. So, let's talk to them about becoming independent of the business and stuffing their personal pocketbook. And so what we're going to try and do is increase the distributions for the business, which is going to increase the amount of personal assets that they have. And once they get the assets out of the business, then we can start thinking in terms of, well, how do we asset protect those assets that are no longer tied up in the business to make sure that they're not subject to claims of creditors. We want them to maximize how much they put into the retirement plan. We wanted them to take advantage of any, of the employee benefits, tax-deductible employee benefits that they can have in their business. And that way we're going to put more focus on them and less focus on, let's accumulate all the money we can in the business itself. Dividends from C corporations are going to be taxed at 15% until 2013. And so, that's a very favorable deal. And, if the business has a lot of accumulated earnings sometime toward the end of 2012, if Congress doesn't look like it's going to act, we may want to make some very large dividend distributions, take advantage of that 15% bracket, because if Congress does nothing, in 2013 it goes back to 39.6%. The next thing is they could take bonuses. They could take bonuses in these next 2 years, and that's going to, keep them in a lower tax bracket and keep them from paying some of these healthcare surtaxes. And we're going to get a lot more assets owned personally, where they can do more effective both estate and asset protection planning. The next thing we want to do is make sure that they're putting the maximum amount they can in their retirement plan. We want them to max out. If they got a 401k, they can max out. If they're over 50, they may be able to make some catch-up contributions. But if the value of their retirement plan has gone down substantially in 2008, 2009, they may not be able to get that all, made up. They may not be able to recover all that ground between now and retirement. And that kind of gets us to thinking about other things that we can do for them. And one of those possibility is a defined benefit plan. It's going to work best for older employers, older owners that have very few employees and have employees who are younger than they are and hopefully make a whole lot less than they do. And the Pension Protection Act back in 2006 allowed you to have both a defined contribution and a defined benefit plan. And so what you'll see is a lot of employers that have 401k plans now, if the owner is older and the census is right, they'll do a defined benefit plan. And that's going to give them a large deductible contribution and allow them to get back to where they would have been with their 401k plan, or maybe even better. And one of the nice things about qualified retirement plans is they're all creditor protected. And the other thing is that the contributions are tax deductible, and so that's going to reduce the amount of money that they're retaining in the corporation. So for the doctor who's making $800,000 a year, who has just a few employees and they're younger and make a whole lot less obviously than he does, that defined benefit plan may be a great way to help him get ready for retirement and to reduce the money that's in the corporation. In a defined benefit plan, you can use life insurance as one of the investments. So you can use stocks, bonds, mutual funds. You can use life insurance. And if the owner needs insurance, that can be a great way for them to purchase it with tax-deductible dollars. Unlike a profit-sharing plan or 401k plan, the defined benefit plan requires a contribution every year. So once again, we would only do this if the business had a steady, strong, steady cash flow, and the individual, the owner, was willing to commit to making that same contribution, year after year after year. So looking out for the next 5 years in the planning horizon, we'd like to think that they're going to be able to make that same contribution every year, year in, year out, without any problem. Again, it only works with the right census, older owner, 50 and up, and very few employees, younger employees, employees who make less. It's a little bit more complicated to explain to the client than a defined contribution plan, but when the deduction can be $100,000 or $200,000 as opposed to maybe 40% in defined contribution, or $40,000 in a defined contribution plan, it can get their attention, and they'll pay attention and learn the few little complicated nuances with the defined benefit plan. this is more estate planning opportunities for 2011 and 2012. We kind of look at what's happened with the ability to make larger gifts, that $5 million gifting ability, and the decrease in asset values that occurred in 2008 and 2009 were, particularly for real estate, it hasn't come all the way back. And the government rates that the IRS tells us what they are every month, the applicable federal rates, the FR rates, which again change monthly, those are at or near historic lows. This presents some great estate planning opportunities, and in the next couple of slides we're going to just talk about some of those opportunities. One of the things that we like to talk about is using gifts to fund a life insurance trust. And some people refer to the life insurance trust, both between us planners and also with our clients, as irrevocable life insurance trust. And if you start the conversation that way with the client, you're really kind of setting yourself up behind the curve, because nobody likes to hear irrevocable, and most clients don't like to hear life insurance. So you've already told them two things that they don't want to hear, and you're just at the beginning of your conversation. And so typically we, at MetLife and I personally, try to avoid talking about ILITs or irrevocable life insurance trust. And I'd much rather talk to them about Dynasty Trust or Spousal Access Trust or Lifetime Access Trust. And the Dynasty Trust is just one that protects assets from the estate tax for multiple generations. So it may be able to prevent assets from being taxed in the parents' estates and the kids' estates. And in some states that don't have a rule against perpetuities, may be able to protect those assets forever, or certainly at least for the grandchildren's lifetime too. And so we may have to pay some estate tax for this generation, but we'll be able to minimize it for the next generation or maybe the next several generations. Or the Spousal Lifetime Access Trust, basically what we do is we have one spouse set up the trust, and we give the other spouse access to the assets in the trust. So even though the trust is quote-unquote irrevocable, we're really going to put the money in today, but we're going to give the other spouse the right to take the money out tomorrow. And so they don't really have to be that concerned about, am I giving this money away forever, irrevocably, just in case I might need it again in the future. Here we can have the spouse have some access to it, and that's going to make them feel a whole lot better about putting that money away. It's one thing to say to the client, we'd like you to put, $3 or $4 or $5 million into this irrevocable trust, and you can't get it back, as opposed to saying, we'd like you to put $3 or $4 or $5 million into this lifetime access trust that your spouse can get at. So you're putting it in there today, but your spouse can get it all back tomorrow if you desperately need it. And, neither you nor I think that you're going to need it, but just in case, you'll be able to get access to it through your spouse. Well, that's a lot easier decision for them to make, because it's not really irrevocable. They can get it back.